Well, I think we're ready to get started on the deep dive today. Welcome. We haven't been around in the deep dive for a couple of weeks. It's Monday, September 20th. Excited to be here. We had Labor Day a couple of weeks ago. We did a recording last week for the deep dive, if you saw that, but grateful to have everybody on this morning and everybody joining. As always, Aaron's going to watch the comments there. Let us know where you're watching from. We always get people across the country watching the deep dive, and let us know what's happening where you're at. We always want to know that as well. Last week we talked a little bit about inventory. We always want to talk about the hottest topics in the real estate market on the deep dive. And if you saw maybe the email or Aaron's post, we're going to be talking about interest rates this morning. Certainly a hot topic in our business. We're not here to give you some crystal ball look, but I am going to talk about what experts are saying. And I'm super excited that we're going to have a guest join us here in just a minute, and Leslie Appleton-Young, KCM's economic advisor. So I'll bring her on in just a minute. But right now, if you're watching the deep dive, share it with somebody that needs to be a part of this conversation, that either whether it's somebody you've talked to about interest rates and what's going on with them, or somebody that just needs more information and could benefit from being a part of the deep dive. Over the last several months, so many people have joined that are KCM members, a lot maybe not KCM members. And more than anything, what we want to do is we want to equip you to be the most knowledgeable agent in your market so that you can help families feel confident when they're buying and selling a home. If you are a KCM member, inside the member area, all of these slides that we talk about each week are available to you. You customize those. You can get them out in the market, make a video, social media post, whatever you're going to do. And certainly tag KCM on Instagram, Facebook, wherever you're posting the information, so we can help you get the information out. So we're going to go ahead and get started here this morning. I'm going to bring Leslie on. Leslie, if you can go on and join us here. I'm so excited for you joining us. And by way of introduction, I'll just do a small introduction and let Leslie introduce herself. She is KCM's economic advisor. Every week, she's updating our research team on interest rates, inflation, consumer confidence, so we can develop some of the talking points. If you see talking points, Leslie's been instrumental in creating those. For 37 years, chief economist at the California Association of Realtors, the largest state association here in the country, extremely influential in the real estate business. Leslie, excited to have you on this morning.
Dave, I'm thrilled to be here. Thanks so much for asking me.
Well, thank you. And we couldn't do what we do without your expertise. So we're grateful for that. So give folks just a little bit of background before we hop into this topic on interest rates of just your career in the real estate business.
Well, I started working at the California Association of Realtors in 1984. And I know today people are used to a lot of job hopping, but I really stayed there my whole career because I love the industry. I was challenged every day. It never looked the same. And there were always surprises in the market. And I certainly have a tremendous amount of humility about projecting what's happening going forward, given just some of the twists and turns we've seen. I think the other thing I'm really enjoying right now, Dave, working with KCM, is having a national perspective. I had the California focus for so long, and now to look at it more broadly. Although I want to tell you, looking at the housing shortage, we had that first,
right.
And the tight inventory. So unfortunately, I have to say that some of the challenges that were really coastal are now across the country. So that's been interesting.
And then no doubt there in that aspect, well prepared for that, right. In your history. There's two things that I know about you, Leslie. One, your experience in our business is unparalleled, unmatched. And two, I love your heart for our business and seeing people, more individuals, more families, be able to buy homes. And that's why we do what we do. It's why we all got in the business. So let me kick off our time. I mentioned before, we're going to talk about interest rates, and I'm excited to just do a little bit of an interview with Leslie. The goal here is to get you the information you need to have a conversation about interest rates, because it's going to be talked about more and more. And I want to set it up this way. With a couple quotes, a couple graphics. Then I'm going to give you at the end a tool that we've developed to help you communicate this to your clients, regardless of what your price point is. Now, again, I'm going to say something I said before. Tag somebody or share this with somebody that needs this information. You're also going to want to go back and potentially re-watch this live, because we're going to talk about a lot of things that you're going to want to get down. But here's the way I would start things. I'm going to start it with a quote from Allie Wolf, trusted source in our business. She says, the single biggest risk to housing is rising mortgage rates. And it's a real possibility the next year that could bring prices down. Further, other economic, financial, and confidence challenges could also result in a drop or flattening of home prices, even with solid buyers in place. But a drop or flattening in the home price is a far cry from the crash we saw during the Great Recession. So let me tell you what we are here today to do and what we aren't here today to do. We are here today to educate you on what's going on with real estate interest rates, mortgage interest rates, so that you are well prepared for the conversation. Certainly not here to say the sky is falling or rates are going to shoot up or anything like that. We're going to share with you what experts are saying right now. And if you start to look at interest rates, let me see if I can advance my slides here. This is what the 30-year fix looks like, having gone back to the front end of last year of 2020. We know we went through the pandemic and we saw rates come down. And the reality is, over the last couple of months, we've kind of been in Groundhog Day, hovering around 2.75, 2.8% in the average 30-year fixed. As of Thursday, the average 30-year fixed in this country is 2.86%. So still very, very good financing. So Leslie, I want to pause here for a second. Here's my first question for you. How would you explain to somebody in this business, or even somebody outside of the business, why we're in the low rate environment that we're in right now, having come through the pandemic and everything in the last year?
Well, I think the answer is it's, monetary and fiscal policy, and monetary policy, stepped up to the plate back in March when the pandemic hit, and it really hit hard, and the 10-year bond fell to 0.54% on March 9th. On March 16th, the Dow dropped 13%. I mean, investors were scared. The economy was shutting down. And so the Fed did two reductions in the Fed funds rate in March and went down to a range of 0 to 0.25%, the lowest they could possibly do. And that has a tremendous impact on short-term rates and really all borrowing rates. So that really ushered in a period where we saw rates falling the rest of the year, right? They bottomed out at the end of 2020. So really the short answer to your question is the Fed engineered that through the funds rate and then through quantitative easing, right? They kind of essentially became the T-bill, the T-bill market. Their balance sheet doubled. They've now got over $8 trillion in assets because they're buying about $120 billion worth of treasuries and mortgage-backed securities every month, right? So there's the pegging the rates, and then there's the tapering issue, the quantitative easing. So there's really two things going on there.
Yeah, I think that here's what I hear in that is instability, brought on by the pandemic. Fed acts, and it sounds weird to say this, but the gift to our business is low interest rates. Right. And that's where we've been. And I'm going to mention this too. If you have a question for today, put it in the chat. Aaron's going to watch that, and at the end we'll grab questions. But so we know that's been the last year and a half, let's call it, in what we've seen in the world. Where are we at right now? We keep hearing, all right, the Fed's going to do something. All right, there's instability in the world, unemployment, all of these issues that sort of have influenced and kept rates down. Where are we at right now? And then the next one is, where are we going, from a question perspective?
Yeah, I mean, right now we're not where we hoped we would be as early as July, when it looked like we were really getting through the tail end of COVID and coming out of it. So the Delta variant and the return of a spike in COVID cases and mandates and vaccination requirements, all of those things really weren't expected as we entered the summer. We thought we were going to have a return to a normal summer. And now you've seen a pullback, right? You see a pullback in consumer confidence. You've seen a cancellations of all kinds of activities and travel. You've seen companies that were going to have everybody back in the office, at least part-time after Labor Day, saying, no, we can't do that. So the honest answer to your question is, we're not quite sure where we are, but we're not where we want to be. And it means that the Fed has a really tough balancing act, right? Because they don't want to tighten up before it's clear that we're out of the woods. And we're not out of the woods quite yet.
Yeah. And I want to clarify that when you say we're not where we should be or wanted to be, you're speaking from an economic perspective.
I'm looking at the macroeconomic situation. And, from being kind of the housing market was the bad child, back in 2006, 7, 8, we have been like the it girl of the pandemic. We have been kind of the positive guiding light, where the action is. So it's a very different position to be in. So when we talk about the concerns we have about the future of the economy, it's kind of like, and then there's the housing market, which has just been driven by the improved affordability, the low rates, and the change in what people want in terms of a home.
Right. And I'll use your words. I think you said it very well. The housing market's really been immune in a lot of respects up until this point from a lot of other businesses that maybe were impacted through the downturn. And certainly on the front end, there are a lot of questions about that. And we talked a lot about it, at KCM. So before I hop into what experts are saying, because I'm going to share some projections in just a moment, what do you see as coming in the future? Certainly the Fed's going to do something, right? I mean, it's just a matter of time. What do you see that as, as going forward, what that looks like? And I'm not asking you for this crystal ball perspective, but what's the next year look like?
I'm pretty confident saying rates are going to be somewhat higher. Mortgage rates are not going to be at this historic low level, let's say 6-9 months from now. I mean, it's very clear that the financial markets are ready to get going as soon as it's clear that we're on the other side of COVID. So I talk about a sense of urgency for players in the housing market today to recognize just how unusual the situation is today with mortgage rates, and that it isn't going to last forever. But the issue is always timing, right? I don't know what the timing is going to be, but I know what they're looking at, right?
Right. And I think that, if we take price appreciation, certainly folks are saying, hey, homes are going to continue to appreciate, maybe not at the rate that we've seen in the past 12 months. Interest rates, certainly the outlook is for them to go up. It's going to cost more. That's going to impact affordability. Now, we've talked a lot about affordability at KCM, but these are the topics I think that folks are looking at. And a lot of people look at the market going, I'm not sure. I feel like things are unaffordable now, or I feel like things are too expensive now. That issue is only going to compound as prices and interest rates go up. Now, I want to share something real quick and head into what some experts are saying. This is a look at mortgage rate projections across Fannie, Freddie, MBA, NAR, and then the average, going all the way to the third quarter of next year. And, if we look at interest rates right now, the average 30-year fixed, I mentioned 2.86%, somewhere in the neighborhood of 3.5% by, the midpoint to the fall of next year. We're not talking about crazy jumps in interest rates. Leslie, I always joke about, we're talking about a rising rate environment and the 30-year fixed could be 3.5%. It doesn't seem right.
For those that have been in this industry a long time, you kind of shake your head, it's all relative, right? But it's certainly the low rate environment has been the enabler of the strength of the market that we've seen with the, as you said, fairly dramatic, strong price appreciation over the last year and a half.
No doubt. So the tool that I wanted to give you, I want to show that to you real quick. It's a graphic that you can use as a KCM member. If you're not a KCM member, you can go to try KCM, start a free 14-day trial. But if you go into my KCM into infographics, we have a buyer's purchasing power graphic for you that you can put in the finance amount based on whether your price point in the market that you're in, wherever that's out, and show people based on where we're at right now, what does that look like as the interest rates start to rise? What's the effect on that payment? And the reality is if you take in this kind of bottom left-hand bucket, if you're financing $400,000 at 2.75, that principal and interest payment is about $1,600. Well, as rates start to rise, and if they were to go as high as 4% in the next, year and a half, which I don't think is outside of the realm of possibility, well, all of a sudden that $1,600 payment, you can only finance $340,000. We all know that people don't, necessarily buy the home price; they're buying a payment. This is a way to show them that as we head into this environment. So I hope it's a tool as a KCM member that you'll go in and use, you'll customize for your area and help educate people on what's happening right now. Now, this doesn't take into account rising price appreciation that we just talked about. And that certainly is going to be something that we will contend with. And experts aren't projecting, what we've seen recently in some things, 18 or 20%, in some cases of the country, higher than that. Appreciation in the next 12 months, but it certainly will be a factor. Leslie, closing thoughts on interest rates. What would you be saying right now, talking to somebody about the position we're in this business in interest rates? And Aaron, I'm going to ask you for questions here in just a second.
Yeah, I think the bottom line is that clients need to do the math and not just take the headlines and factor in that the economy is growing. I mean, we are in recovery. I mean, there's no doubt about that. And that the Fed is very serious. They have to raise rates so they have something to play with for the next downturn. You know what I mean? When you're doing what we're doing today, there's not a lot of leeway. So we don't know the timing, but we know that it's coming. So do the math and see what makes sense for your budget and your goals for wealth creation over your lifetime, right? That's really you're playing the long game when you're looking at housing.
Yeah, no, it's a great point. Leslie, I'm grateful for your economic insights today here on the Deep Dive, but also all the work you do to help so many KCM members through the research and things that you do that allow us to put out the great information into the market. So I want to pause for a second. And Aaron, do we have questions?
We have, so Jim was asking about, he said it's a factor in Boise, Idaho.
Okay.
A risk is that in many markets, they're appreciating over the FHA
Sure. So Jim said in Boise and Idaho, and you certainly know this, Leslie, a lot of appreciation out there. A lot of folks coming out of California, cash in hand, and driving prices up above the FHA loan limit. Not something we're going to address here, but no doubt that's happening and happening to a greater degree there where you're at, Jim.
The migration that we have seen over the last year and a half has definitely seen a tremendous acceleration as people have been able to work from anywhere, and they're taking advantage of that.
Was there another question?
Connor had a question. What kind of an impact would the MBS market see if there was a debt default by a company such as Evergrande?
So there's a question Connor asked about mortgage-backed securities and what would happen if there's a default. I don't know the extent of the question. If you're talking about what would happen in a 2008 level default, where you're talking about reps and warrants and some of these folks that securitize mortgages, I can tell you this: experts do not see anything remotely like 2008 for a lot of different reasons, but one primary reason that today is dramatically different than 2008 is equity. That's the simple answer to a lot of things. There is a tremendous amount of equity where back in the housing crisis, there was no equity. And that caused all of the issues that we had. There were a lot of other issues with oversupply and things like that. But I don't know if there's anything you would add to that, Leslie.
No, I think you covered it. Looking at the foreclosure rate is what, below 2%. I mean, this isn't going to be a big issue because why would people foreclose when they could sell their home and have typically a lot of some equity in it?
Yeah, yeah. If you've been following the deep dive, folks, we've covered forbearance. We've covered this equity topic extensively, and it's just dramatically different than there. Any other questions?
We have a question from Steve. How do you tell the story to sellers that now is the time to sell, especially in a move-up situation?
It's a great question. The question, Leslie, was how do you tell the story to sellers that now is a move-up time to sell? No doubt we need inventory across the country, and I think understanding what's important to a seller is what's key today. Now, the objection that I see most times, or that I hear from agents, is, the objection of why would I want to sell today? Because I can sell my home at a premium, but I'm going to have to then pay that to move into something else. Here would be my simple answer to that. Right now, what we know, interest rates are historically low, and the outlook is they're going to rise. Second thing, we always say anything you buy today in 10 years, you'll be bragging about. And the question I would ask them is, if you could go back and buy 10 years ago, what would you do? Their answer quickly would be, I would certainly buy. And if I could, I'd buy 2 or 3. I'd buy as many as I humanly could possibly do.
Why did I sell my first house? I should have figured out a way to hold on to it.
Absolutely. So it's a great question. I think it's one that we're all dealing with. And I think it comes down to what's important to them in helping them see into the future what they may move into that may fit their needs better. We know without a doubt, home has changed in its meaning over the last year. And what people need is far different than what they went into the pandemic needing this past year.
Right. And the great majority of sellers are going to be buyers, right? So the buying environment is equally important.
Yeah. Anything else, Aaron? All right, we'll wrap up on that. Leslie, thank you for joining us today and sharing just your insights. I know we went a little bit longer this morning, but I'm grateful, Leslie, for you joining, and always grateful for the research and insights you bring to KCM.
You're so welcome. I really enjoyed it.
All right, we're going to wrap up this deep dive. As always, we love seeing you here on Monday mornings. Great way to get the week started. If you're a KCM member, go in and grab these slides. Use them as you communicate what's happening with interest rates. It's a question I'll guarantee you folks are going to ask, and I believe in the coming months, in the fourth quarter, as we tail out through the year, it's going to be asked more and more. So have a great week, and we'll see you back again next Monday. Take care.